I'm Stoyan Tenev, I'm in IEG, and I would like to welcome you all to this learning event on bridging the gap, how to finance universal access to housing by 2030. And just some logistics before we get really started. We would like to make this event as participatory as you wanted it to be. And we are going to use a poll everywhere to crowdsource questions from those of you here in the audience and those of you watching us online. And so I would like to, if you have your phones, to take them out and to go to your browser and type pollf.com/IEG now. I think you have instructions on your tables and behind me on the screen. So it's pollf.com/IEG now. And we can test the tool by, you can answer this question that some of you may relate to for some. All right, there you go. Okay, good. So it's all right. Okay, it's very evenly spread now. Good. We're hedged. No, all right. Oh, things start moving. All right, another one. I think we don't need that, but if you're, you may just try this one as well, just to make sure that we are. Excellent. I think things are working. So as we go, feel free to send questions to the panelists, and we'll try to answer them as we reach the second stage of our event today, where we will have an open discussion between the panelists and the audience. And so here is the plan. In a few minutes, I'm going to give the floor to Marvin Taylor-Dormont and Marcus Bruhis to say a few opening remarks, after which Marlena Pinglo will present an IEG paper which summarizes lessons from World Bank Group support to housing finance. Following Marlena's presentation, I'll introduce the panelists and we'll have a discussion, 2 rounds of questions. And we will try to make it short so that we can leave plenty of time for you to participate and ask your questions to the panelists. So with that, I would like to ask Marvin Taylor-Dormont to say a few remarks. Marvin is the director of IEG, responsible for private sector development, financial sector development, sustainable development activities of the World Bank Group. And he has a long career in the Central American Bank for Regional Integration and also in the government of Costa Rica. Marvin, thanks.
Thank you very much, Stoyan. Thank you all very much for joining us this afternoon, and thank you so much to the distinguished panelists that we have this afternoon with us. The work of IEG is sustained on 2 pillars, if you wish. Right, on the one hand is accountability, and on the other is learning. Obviously, these 2 pillars interact very dynamically and actively in the work that we do. On the accountability side, our purpose is to focus or pay attention to the objectives, the extent to which the objectives that have been agreed on between management, the board, the clients have been achieved. We also focus on the comparison of performance by sectors, by countries, etc. On the learning side, our focus is on what works, what doesn't. Can we replicate what has been done with success? Should something that the bank group is doing be stopped? Should something be initiated? Should be continued? That is the nature of the work on the learning side. And over the last 2 years, we have been paying special attention to the learning side of our work. In fact, our TORs have been recently amended by the board last week to emphasize the learning side of the work of IEG. And this is precisely what has brought us together today. We have produced this work on housing finance with learning purpose emphasis. That's the key objective of this paper. Is short, and we work in the production of this paper. We work together with management so that we can absorb together as well the lessons. And the purpose of this session is precisely to expand on this absorption of lessons in this specific field of housing finance. This paper places itself in two spaces. On the one hand, on the financial sector, the development of the financial sector, and there we have been doing a number of pieces. We've been working on financial inclusion. We're working on SMEs, microfinance. Some of you have attended the events that we have been conducted in this space, and these capital markets. And this short piece comes to complement our work in that space of financial inclusion, if you wish, and development of capital markets. The other space is the provision of shelter, a huge, tremendous problem that humanity is facing with the acceleration of the urban process. The bank group, obviously, is involved in the expansion and the provision of shelter. And one of the instruments that it uses is precisely housing finance. So these are the two spaces in which this piece is framed, within which this piece is framed. And we have a great number of panelists to share with us their perspective, their views. And as Stoyan said, we expect to have an interesting interaction. And to kick it off, we have a Marcos Brujis, a director for the Financial Institutions Group, Global Director for Financial Institution Group in IFC. As you know, about 40% of the operation of IFC are in the financial sector, and Marcos is the director of this part of operations of the institution. And we have shared with you his background and experience, and it remains only to listen to his introductory remarks. So thank you very much, and let's have a good session. Thanks.
Thank you very much, Marvin. I was very pleased to hear your comments about IEG focusing more on learning than on evaluation. I mean, when I started at the World Bank Group, the sole focus was evaluation. And for us, it's the equivalent of changing the carrot for the stick. So we are very pleased to see this learning emphasis that's happened under your leadership, and I think it makes a big difference in the approach, and it makes the role of IEG very useful. So thank you for that extraordinary effort. The 2030 goal of providing access for all to adequate, safe, and affordable housing and basic services, and the need to upgrade slums is one we are committed to. Half of humanity lives in cities now, and about 828 million live in slums, a number that is sadly increasing daily as more and more people in developing countries flock to cities. We need 96,000 units of housing per day through 2030 to cope with demand and meet our target. This task of providing what is the most basic need, shelter, is a massive one, and it is one that governments alone cannot solve. Even with the best will in the world, providing solutions to housing crisis requires a multifaceted approach and the active involvement of the private sector. This includes financial institutions, as well as property developers, city regulators, and construction companies. Our data shows that 93% of adults in emerging markets have no access to formal housing finance. Mortgage markets in many developing countries are often very underdeveloped and only open to those in the top income scale. And that's why we, in IFC's Financial Institutions Group, or FIG for short, are acting to change that. We work with more than 700 financial intermediaries around the world to strengthen and build a responsible financial sector. Working through these financial intermediaries helps IFC reach far more individuals, entrepreneurs, and small businesses than we probably could on our own. Housing finance is a key priority for us. We now have about 40 active clients in 29 countries. In 2014, these clients issued 966,000 housing loans worth 22 billion, at least 47 of which were for newly constructed homes. FIG collaborates with the MAS department, or the Manufacturing, Agribusiness and Services department in IFC, to invest in developers who may be most used to dealing with upper middle class customers and encourages them to move down market in stages. This means producing housing stock and housing finance for those on middle incomes, and then those on lower incomes on a step-by-step basis. Our shared goals mean that we coordinate out our work across the World Bank Group, such as with the global practice of social, urban, rural, and resilience, SUR for short, on city planning, regulations, and slum upgrading. F&M on microfinance and developer finance, and also those in climate change. As we know, 19% of greenhouse gas emissions come from buildings, something we are working to combat through the EDGE Green Buildings program. As we continue to grow this business, we welcome IEG report and its findings. We appreciate that the report recognizes the strength of our strategy and approach and the impact we are having. Where we have lessons to learn, we will take cognizance, improve, and do better. I really look forward to a discussion today. Thank you.
Thank you, Marcos. And let me now ask Malena Pinglo. Malena is an evaluation officer in IEG and the author of this report that you all have copies of. So, Malena, the floor is yours.
Good afternoon. Thank you all of you for being here. Thank you all of the ones that are web streaming today as well. I wanted to give a special thank you to the World Bank Group staff that collaborated and gave me their insights when preparing this learning product. I'm here to talk to you about the World Bank Group support in housing finance and share some key lessons that we came up from the learning product. When IEG asked me to undertake this assignment, I took it because I have personal interest in this subject. Back in 2007, there was a construction boom in my country. And I was playing with my son here, and I received a call from a friend that my house was featured in all the news. And so I called my parents. I couldn't locate them, and I had to go over the internet, and yes, my house was all over the news. It had collapsed because there was a construction boom, and a lot of construction companies that started to appear started to build without adequate quality. Therefore, a badly built retaining wall fell on top of my house. You can imagine how I felt, but my parents had to apply for a mortgage construction loan. And my mom, self-employed, could not include her salary in the mortgage application. As a result, the mortgage was not an option for them. Many middle-income families have the same problem. While they have the resources, they cannot access to loans. The reality is even more dire to low-income housing. Low-income families have the same problem, but I can show you what the World Bank can do to help. Like, for example, in Rahiz's story, Rahiz and his family, Rahiz had a housing dream. He wanted to build a house for him and his family, but he was self-employed. He was living in a rented slum in India, earning $400 per month. The International Finance Corporation helped a housing finance company identify Rahiz as a potential client and gave him a loan that was according to his needs and his capacities. They gave him an incremental construction loan, and he was able to build a house progressively. But not everybody is as lucky as Rahiz. Mortgage markets remain weak and underfunded in developing countries. Mortgage to GDP ratios are below 10% in many of these developing countries. On top of that, the housing landscape will change dramatically over the next 2 decades. There is inadequate conditions that will worsen. It is estimated that 200 million households are living in inadequate housing, and this will increase by more than fourfold in 2020. There is also growing demand being pushed by urban migration and income growth. It is estimated that 1.6 billion people that live in urban households will live in inadequate, unsafe, unclean, and will be financially stretched by 2025. Also, there's urban population growing exponentially. It will increase from 2 to 5 billion in 2030. All of these challenges stress the importance of housing and of housing financing. But the World Bank Group is evolving and has evolved into an integrated and comprehensive strategy, taking into account demand and supply factors. Also trying to have intervention across the entire value chain, from city planning and building regulation to end user finance. But the World Bank Group is devoting limited resources. Resources in terms of volume and number of projects is below pre-crisis levels. And a portfolio of 5.2 billion is very low compared to a housing gap of between $9 to $11 trillion. What follows is what we have learned from the report. It's going to be illustrated by some country examples. The review found that the World Bank Group is focusing on countries with the most need. A large share of World Bank Group projects target countries with the lowest and low housing finance penetration rates. At the same time, still the gap is wide. A large share of countries do not have World Bank Group support. Given these challenges, it's very important to learn from experience. We found that knowing the market is crucial. Knowing the market to design and target the interventions. Take Vietnam, for example. The IFC gave a loan credit line that was based on cross-currency swaps. The problem was that in Vietnam, the market for those swaps does not exist. So you need to know your market. Some preconditions must be in place, and this is linked to the first factor. There are some preconditions that must be in place in order for the housing finance to succeed. And those are, for example, having a sound financial infrastructure, having adequate risk assessment and management, avoiding severe inflation, and having adequate and sound regulatory framework. In West Bank and Gaza, a loan went ahead without paying attention to land registration issues. This was a complex issue that needed to be addressed first. Depending on the country, there are some binding preconditions that must be addressed first. But we live in an imperfect world, and not always the preconditions are there. And we have found that when this happens, timing and sequencing are key. Take Colombia. The World Bank and the IFC both help with the housing law, and then enable securitization. The IFC came and supported the securitization conduit at the right time, because they had emerged from a financial crisis, and the lenders were eager to securitize and take their assets off balance sheet. We also have found that working with committed partners is crucial. In Morocco, a sustained loan income program was successful, and it was attributed to the work of the committed partners, in particular the government. What follows is some key findings by type of interventions. We found that it is okay to support non-banking financial institutions, but mostly when they are unable, or when commercial banks are unable or unwilling to lend. This happened in India, for example, when the commercial banks were precluded from going to mortgage lending. And then the housing finance companies appeared to bridge this gap. It also happened in Mexico after the financial crisis, when banks were not willing to lend for mortgage unless there was for high-income population. Non-banking financial institutions have advantages. They know the market niche, and they are able, if they are successful, to attract commercial banks and enable market transformation. But they, at the same time, are very vulnerable and need to diversify or convert into a bank in order to survive. The example of Mexico with the Sofolias, for example, they were too dependent on capital markets. They had no prudential regulations. They took excessive risk, and there were significant competitive pressures. On the other hand, in India, the housing finance companies were more resilient to the crisis. Why? Because they had stricter prudential regulations. They lent conservatively. And they had diverse sources of funding, including the government. For capital market interventions, what we see the success in securitizations require a developed government bond market and a need of lenders for capital relief. That's what happened in Colombia with the IFC-supported securitization conduit. It had a relatively developed government bond market, and the lenders were eager to, as I explained before, to securitize their assets. So there was a need for capital relief. In contrast, in Peru, when the company was formed, the lenders didn't want to securitize their assets because they had a lot of liquidity and they could find cheaper sources of funding. Liquidity facilities are more helpful in countries with shallow bond markets, but they still require benchmark yield curves, institutional investors willing to buy the corporate bonds, and market liquidity. In Jordan, this is exactly what happened. It had a shallow but still liquid bond market, and institutional investors willing to buy them. In Egypt, they have been able to increase the mortgage lending, but they have yet to be able to have corporate bonds. This raises some issues about sustainability. In affordable housing interventions, we found that targeting is crucial. In Egypt, for example, the World Bank went ahead with targeted low income when there was no mortgage financing. As a result, who benefit from this program was a higher income bracket. Avoid foreign currency loans. In Ukraine, an IFC-supported project gave foreign currency loans to a bank. They were to borrowers that make earning local currency. But what happened is that initially, while this seemed like a cheaper alternative, affordable for borrowers, because the rates were below the market rates, when the country devaluated, the most vulnerable borrowers suffered a lot. So going forward, remember the challenges ahead. If nothing is done, inadequate housing will worsen, housing gap will widen, and access to housing for all will unlikely be achieved by 2030. What works? Remember, know the market, target appropriately, binding preconditions go first. Timing and sequencing matters. Work with partners, find champions. Thank you, and looking forward for a fruitful discussion.
Thank you very much. Marlena, thank you. That was very nice and useful summary for this product, and there is so much more in the paper, so I would encourage you to take a deeper and more careful look at what is there. And that provides a very useful background for the discussion to follow. And let me introduce our panelists. We have a fantastic panel. To my right is Mr. Alan Elizondo, who is the central banker on the panel. Mr. Elizondo is Director General for Financial Affairs at the Bank of Mexico. And he has an illustrious career in government and in financial sector, working on risk issues, affordability issues, and housing finance in general. So very happy and pleased to have him on the panel. Further to my right is Mr. Loic Chiquier, who is well known to all of you. Loic is our foremost capital market, financial market expert in the World Bank Group. He is a chief technical specialist in the FNM, Finance and Markets Global Practice. Before that, he was Director for Capital Markets Global Practice and Director for Financial Private Sector Development in the MENA region of the bank. And he also has had a life before the World Bank Group in the private sector, dealing with financial sector issues. So, and Loic just comes off the plane, I guess, from a long trip, and we're especially grateful for the effort and for being here. To my left is Brett Gwinner. Brett is the head of housing finance in IFC. He brings a lot of experience in working on housing finance in developing countries in Latin America, Africa, Southeast Asia. He was, before joining IFC, he was in the World Bank dealing with similar issues related to housing finance. And before that, he had experience in the private sector consulting for Fortune 500 companies and for financial institutions. And further to my left is Professor Van Order, who is the chair of the Department of Finance and Real Estate in George Washington University. He has taught in many universities in the United States and in Europe. And he, before joining academia, he was chief economist for Freddie Mac, and also has had a distinguished career in government, working for the Department for Urban and Housing Development. So I think with that, we can see we have a lot of expertise that we will bring to bear to the issues that are of importance for us in affordability and access to housing for all. I would like to approach the issues from the outside looking in, and we'll start with Professor Van Order. Can you please give us a sense of some of the trends that you see out there in global housing finance, including in developing countries?
So I think I'll talk about changes, but also about lessons. When we talked on the phone last week, they said I have 4 minutes, so I have 4 points, 1 minute each, which will pretty much exhaust what I know. The first one about lessons, and of course my experience is colored more by the U.S. because I worked for Freddie Mac, but I've done some work on international housing finance as well. But a first lesson is more a thought one, which is, what is it that matters? In the United States and in other countries, we talk about things like secondary market facilities, government-sponsored enterprises, and banks. I'm now chairman of the finance department, so I have to talk about finance theory. But one of the central premises of modern finance theory is something called the Modigliani-Miller theorem. Both guys got Nobel Prizes. But the basic idea of it is that that you have to be, the pieces tend to add up to the whole if the market's competitive. And the example of this is a story, a guy goes into a pizza place and he says, I'm really hungry, I want to order a pizza. And the guy says, fine, what kind? He says, pepperoni or something. And he says, I'm going to cut it. Would you like me to cut it into 6 pieces or 8? And he said, well, I'm kind of hungry tonight. Why don't you cut it into 8? Now, the lesson there is in thinking about financial contracts. They're carved up, but you have to be careful not to be obsessed with the carving up, with the institutional structure. Is it a securitization? Is it this or is it that? It's assets on one side, liabilities on the other. And all the choices that you have are doing functionally the same thing. The policy question that I think we've learned about in the United States, but in other countries, is it's not really about whether you have government-sponsored enterprises or banks. It's about how these structures work, and are there risks hidden in them that you don't know about. We saw that in the United States in the private market with the private label securities. We've seen it with banks in taking risk because of insured deposits. And we saw it with Fannie Mae and Freddie Mac. So the thing is not to be overly focused on institutional structure, but on functions and rules. Second, in terms of sequencing, a thing I have learned about in looking at other countries, in a part of the sequencing that's really important, and I've seen over time here, but in other countries, is the legal structure. You really need to have that if you want to have serious mortgage markets. I used to give talks. I've been an academic for a while, and then I worked for a company, but I used to give talks about this in the 90s. And I would have a PowerPoint, and the PowerPoint would say on it, if you want people to have good housing, you have to be able to take it away from them. What do I mean by that? You have to have the legal structure so that if there's going to be a mortgage market, that the collateral is actually good, because that's the difference between right now in the United States being able to borrow at less than 4% for 30 years when you have a house securing it versus 20% on a credit card if it's not. And this is important, and it has to do with title. That's one of the first things in emerging markets in places I've worked at that you really have to think about. The second is foreclosure, being able to take the property, being able to say, yes, you promised me this is collateral, I gave you a low rate, I know it hurts, and I know there's political opposition, but in the long run, being able to take the collateral is the difference between a low rate and a high rate. And finally, foreclosure. And I'm going to tell you one quick story about years ago in Russia in the 1990s, and I may have been with Loic then, I'm not sure. But this was in the wake of the Soviet Union, and we went around to different banks to talk about mortgage markets. And in Russia, there was a problem with taking title and especially with evicting people. These were units that were essentially apartment buildings, flats. And we went to the first bank, and the guy in the first bank said, no, there can be no mortgage market in Russia. We can't evict people. We went to the second bank, and the guy said, well, that's not quite true. We can just turn off the heat. And we went to the third bank, and the guy said, no, it's no problem at all. We have these people we call lawyers who help them move out. Now that's not the way you build a world-class market. The legal structure really is important. Third, government. What's the role of the government? Big deal in the United States, big deal in other countries. I like the idea of setting things up where most of the time you rely on market incentives and a good legal structure. Whether the government intervenes in the form of government-sponsored enterprises like Fannie Mae and Freddie Mac, or in the form of bank regulation and insurance, is not all that different. What does matter, I think, and that we've learned, is you do indeed want to use the government, I believe, to keep the markets open. That's very important. Keep the market open at market rates. And I think in some ways that's worked well here recently, in some ways it hasn't. You can do it with deposit insurance. You can do it with guarantees of government-sponsored enterprises. But they need to stay at the end. I think you really want competitive markets if you're serious about having a world-class mortgage market. And finally, final point is the question, what about multifamily? A lot of the problem, as I understand it, is urbanization. And actually, rental units and apartments are a kind of an important way of doing housing in urbanizing places. And in some ways, those are easier markets to run. Well, a lot of the problems of foreclosing aren't such a big deal if you're foreclosing on a landlord, but not necessarily touching the tenants. And one of the things I think to think about is, which we've not looked at maybe as much as we ought to and we've taken for granted in the US, but it's cropped up, it's become a bigger deal lately, is understanding financing multifamily, because that's much more like financing a business or a corporation, and that's just an easy thing to handle. I'll stop.
Thank you so much. That was a useful reminder of some of the principles and the constraints and the factors that one needs to take into account or deal with trying to address these big problems. Now let's go to Mr. Elizondo, who is going to take us tell us how things look in Mexico, a middle-income country is facing some of these big challenges. What are some of the practical issues and challenges that you're facing in Mexico at the moment?
Thank you very much. Well, I would like to first thank the invitation, and I'm very happy to be here and share the experiences. For the case of Mexico, I would like to try to talk about 3 models that have been working in different phases, and that we might draw some lessons from each, so that, and we can also talk about how the World Bank Group has helped to make these 3 models instrumental. The first one is, I will start with the private sector, just having the private sector as the most important financial source for housing finance. This will be the first one. The second would be the government, having only one institution that would be responsible for housing finance and low-income finance. And the third one would be a hybrid between the private sector and the government that actually was instrumental. The World Bank Group was instrumental in setting up things for this third facility. So starting with the first, the private sector was mainly represented by banks, and the private sector played a very important role previous to the peso crisis in '95, before, and after the 2008 crisis, you got the private sector playing the most important role. What happened with the private sector? Well, it was mostly directed to the higher income. Previous to the peso crisis, some imperfections in the origination. You did have a very large origination process in volume, but you got interest rate risk. All the mortgages were ARMs, and the risk was borne by the individuals. And also credit risk. The credit risk origination process at that time was not very much regulated. So with the peso crisis, that model disappeared. And then we got the second phase, which was after 2008. After having this hybrid model that I will speak further, disappearing, the private sector represented by banks started to play an important role. But for housing finance and low income, I would say that it is very difficult that the private sector would go alone to the lower income segments. So this is the first one. The second, for the government role in housing finance, in Mexico we have another extreme, which is an institution that is administered by the government. It's actually represented by the government, the workers, and the employers who manage this institution. And this institution is fed by a 5% payroll deduction for each formal employee. So this is, we could consider this very similar to a tax. So if we have this source of funding, well, no matter if you have a financial crisis, no matter if the the economy is doing bad, you will always have this source of funding flowing, and then this money, if well administered, can serve to finance the housing. So this institution has been there for the whole time. It has a capacity, a very strong capacity, that it can collect monthly payments directly from employees and from employers, sorry. And this makes a very powerful model for housing finance. And well, what are the advantages? Well, it's, as I said, it remains as a very powerful source of funding. You don't need to go to the markets, and even it can play a very interesting role when you have a crisis. In 2008, this was a very important counter-cyclical facility which provided finance to the sector, and the construction process remained in place. Some disadvantages, well, interest rates are set by law, so it's a very rigid process. It's not always compatible with the private sector, and it can also, at some times, disincentivize the private sector to enter into this lower segment of housing. And then finally, the third one is the hybrid model. The hybrid model was one that played a very important role in between the two crises in 1995 to 2008. Since the banks were out and there was no source of funding, an initiative to create specialized and non-regulated entities was placed in 1995. So these intermediaries were developed. The World Bank played a very interesting role in developing capacities, not only for these institutions, where you needed to create the capacity to originate mortgages and then keep them in balance sheet and afterwards to sell them to the market. But the World Bank was also instrumental in creating this specialized wholesale funding facility for the government. There was already one, but the professionalization of this institution was instrumental in having this government institute playing with the private sector for financing housing. Just to finish, this model actually grew successfully. We had the IFC investing in the capital of these institutions, and also investing in some guarantees for financial transactions, for securitizations, making this development not only public sector, private sector, but also involving the securities markets. So that was instrumental. And also, you got the World Bank developing this facility by giving the capacities to manage asset liabilities, creating the mortgage insurance product, standardizing mortgages so that they could be sold to the markets, preparing subsidy programs that were compatible with the securities markets, and also fixing interest rates and standardizing the products so that these mortgages could go to the markets. At the end, well, this we will talk later. The model collapsed in the 2008 with the crisis, and some of the reasons are interesting to draw lessons as well.
We'll get to that. Thank you so much. I think that was very useful summary of the evolution of the approaches in Mexico as the country has learned and how things evolved. And you also touched upon the role of the World Bank Group in this process, which is a nice segue to what I'm going to ask Loic to talk about. Malena also mentioned that our approach has also evolved with the times and with the evolution that has taken place in our clients, from more or less self-standing, standalone involvements to a more holistic, programmatic, integrated approach where we look at the entire value chain. And Loic, can you please talk about that and about the challenges that we face in ensuring that our interventions are aligned along the value chain of this complex process and system?
Thank you, Stoyan. Hopefully, we don't have 2 hours because the question is very, very large. Just to say, maybe to start, when I started the World Bank, it's A lot of people share a passion for housing and housing finance. I have the passion. So when the World Bank recruited me in '98, one of my first clients was Alan Elizondo. He's still a friend. We have done 4 or 5 projects together, more than probably $1.5 billion of DPL, investment loans. I don't count the number of RAS and TF and trust fund. My point, my segue is to say it's a journey, right? You start in a country, it's going to be a journey. And the best reward is when you see your client doing things not 10, 15 years ago. There was ups and downs. We went through at least 2 crises together. And we learn from the crisis, and we learn from our lessons. We try to replicate, and improve each time. So number 1 is a journey, right? Number 2, it's a scale-up story. It's a scale-up story. On sense, the report pays justice to the fact we're doing our very best World Bank Group, and we're trying to harmonize our work together. But the gaps are huge in emerging countries. They're huge. Pretty much some region, at least, we don't see many of the other donors or the multilateral development banks. So we have even more responsibility in leadership, convening power, and try to really work with the others. We'll not do it alone. Not only we have to work with others, other players, but we also have to integrate our work together. World Bank, IEG. When I say World Bank, it's TNC, it's SUR, it's FNM, because it's a really complex, by definition, housing is a complex story. You have demand, supply, many constraints on both sides, right? So this is something which requires not to be very comprehensive. So one of the things we've changed probably, we've been trying to be much more comprehensive, at least at the assessment stage, right? You start, you're asked to go to a country, we're trying to bring on many, many players. I'm just back from Pakistan, where we had the joint mission IFC and World Bank, right? We have done 2 studies, now IFC has done, we have done some studies. We are asked by the government to really see what can we do really now to scale up this market, right? So it's really a 3 or 4 parties story, and none of us alone can do it. Let's be clear. So the assessment has to be thorough, and even if you find a lot of really very difficult challenges, right? I'm, of course, biased. I'm coming from Pakistan. 2 weeks ago, I was maybe in Argentina. My diagnosis would be different. Here we come, forgive me, because I'm putting you this case, right? Just fresh in my mind. You have a huge problem, of titling, of foreclosure, of inflation, of banks, everything you can imagine. You have to be able, in this galaxy of problems, to find which one is the trigger one that really is going to be prerequisites, and without that, the rest doesn't matter, right? In this case, it's probably foreclosure, right? We have a mortgage market in this country, 0.5% of the GDP, 30% NPL. Good luck to you. To encourage banks to come in and other players, right? Or developers. So we have really to understand what was the issue. Why didn't it work? Why people think it's a huge risk and the worst possible asset on the balance sheet. Whereas in countries, most developed countries, mortgage market is usually the best asset, right, in terms of risk class. So you have to adapt, tailor, and understand each local. So this, I think, Maria Elena has been fairly saying that, you have really to follow and understand which is the sequence. Now, when you say that, you cannot put a list of do's and hope that all the prerequisites will be there, because you may wait 30 years. If Mrs. Ngozi, when she became Minister of Finance in Nigeria, and some of you here in the audience worked in Nigeria, waited for all the to-dos and prerequisites to start, nothing would have happened. So you have to target which are the entrance point, which are the key reforms you can work together and start. Remember, it's going to be a journey, so you're going to do different steps, right? And don't try to overload your project, right? Last, maybe 2 or 3 points. We have a range of products at World Bank Group, right? We have lending, we have TA, we have knowledge, many things. I think we have to think about the impact. Where is going to be the most impactful? And it's not always a lending operation. Because altogether, the size of what we speak in markets, the gaps we're speaking, are sometimes in hundreds of billions of dollars. In a country like India, both IFC and World Bank are working there. The gaps is several hundreds of billions of dollars, right? Out of which the creditworthy one is probably already huge, beyond anything the World Bank Group, all balance sheet, all lending could do. So the important thing is really to focus on the catalyst. What reforms you're going to finance, what demonstration effect you can do, which will inspire the private market, to pick up on with leveraging more state interventions. I know it's sometimes difficult to keep this long-term objective in mind when you are asked as a TTL, some of you, to design a project, make sure the disbursement is right, everything. So keep in mind it's a journey, and I'll be happy to elaborate on more examples later.
Thank you so much, Loic. Britt, We heard these numbers. They tend to be discouraging. The task seems to be very big, and there is this realization that we cannot make progress without mobilizing and involve the private sector in it. And can you please share with us some of your thoughts or challenges, and how is IFC looking at this challenge of bringing the private sector to work towards this challenge of creating housing for all?
Sure, I'm happy to. So first, let me just acknowledge the work that's been undertaken here by Malena, by the team on the IEG side. It really was a learning process and a collaborative process. I know you spent a lot of time with Freddie Roy in our group and other people on the bank side, and we appreciated that, and we were happy to take part. And I think the result speaks for itself. So thanks for that. In terms of bringing in the private sector, it is critical. No government in any country has been able to solve its housing problem with public investment. There's just never enough money. To bring the private sector in, you have to make it an attractive business for the private sector. It has to be profitable. If you're a developer in Kenya building $300,000 houses for clients that are in the 1% of the income distribution, the top 1%, and it takes 6 months to execute the sale of that property from you, the developer, to the buyer, that's okay, and it costs 5 or 10% of the price of the overall house. Who cares? The buyer's not going anywhere. She's got the resources. She's building this house. It's her custom house of her dreams for her whole family. But if you want to build something that addresses the bulk of the market, which is a need for 150,000 housing units every year, priced between $3,000 and maybe $15,000, it cannot take 6 months to transfer title. It has to be cheap and fast, and it has to be a sure system. As Bob was saying, on the legal side, you have to be clear that you really are buying and selling something, and that there's nobody going to come up to you in court a day later and make you pay again to buy that piece of land one more time because they have some claim that wasn't clear in the registry. So the registries have to be clear and efficient and cheap. The process has to be cheap. You have to be able to foreclose and take the house away if the person doesn't pay. And everybody has to be clear about what the deal is. When you go in to buy a house with a mortgage, you're offering this house as collateral, even if you have it in your name. But that means if you can't pay, you have to hand the property over. And the system has to support a process that protects both the buyer and gives them rights and a time period in which they can assert their rights and maybe work out problems. And then on the side of the lender, they have to be able to have an actionable collateral. So that, this is a business more than many other businesses in which we invest that really requires a directed and positive and effective role on the part of the government to build institutions that support it. When we think about the businesses themselves, sort of one of the first things we think of is how do we formalize the development industry, and then how do we finance that, and then finance sales. So a lot of what we're working on is scaling up by supporting developers, but to produce larger quantities of lower cost units. And a lot of the countries in which we work, that's one of the biggest issues. Like in Kenya, the average price for a unit sold in the private sector last year was about $240,000. That's out of the reach of 99.9% of Kenyan households. It's just not for the formal sector, it's just not attainable for most people. To move that to a mass market means making it an attractive business. It means capital, and it means technical capacity on the part of builders. And so we're investing in that. We're investing with lenders so that they can deal with mass market borrowers, which is a change for a lot of lenders in a lot of the markets in which we work. Indonesia, similar to Kenya, takes a long time to file a lien. And the lenders are really used to dealing with formal sector, formally employed borrowers. It's a big leap to move to the majority of workers in the economy that, as Malena was talking about, are informally employed. They have resources. They can't afford a $300,000 house, but they can afford a formally built product that meets their needs, that's priced and that's technically adequate for their needs, if it's produced, and if the bank's willing to do the work that it takes to evaluate what they bring to the table in terms of their monthly earnings and the sustainability of those monthly earnings over time. And increasingly, we're seeing lenders that are willing to do that. In India, just this morning we had at the investment review process a $40 million line of credit to a lender in Southeast India called Repco that's dealing with informal borrowers for the most part. And we have several lenders like that we're working with in India that have used a combination of just old-fashioned labor intensity and having people that understand markets, understand neighborhoods, understand individuals and their sources of incomes, and then some that are employing some interesting high-tech approaches to data mining and combining with software tools at the assessment level. So we're looking to do that and scale those up. Scaling up rental, Bob mentioned multifamily as it's called in the States, but rental housing, most of New York City is most. There's a large portion of New York City households that rent their dwellings, and most of those buildings are owned by insurance companies. A lot of New York was built in the 1950s, what we think of in Manhattan, all those high-rise apartment buildings were built by pension funds and life insurers. We can do that. In Kenya, again, $8 billion is sitting in private pension funds that's mostly invested in short-term government bonds. It should be invested in long-term assets. Apartments are a great way to do that. And IFC's just financed a portion of a REIT, a real estate investment trust in India in Kenya, that's starting out with commercial properties. We'd like to do that with rental properties in more countries, like in Mexico with Fibras, with a similar REIT-type structure. So capital market linkages are really important. We stumbled on those in Mexico. We would go back to them in Mexico, nevertheless, with lessons learned, and we would certainly look at it in other markets. It's a tough thing to bring to many markets. As Malena was mentioning, if there's really nothing happening at all in corporate bonds, a mortgage-backed security can be a way, maybe a REIT structure, other structure can be a way, but there's a lot of issues with starting something from scratch if there's very little liquidity. So let me just wrap up this initial comment with agreeing with Loic on one important term, this concept of journey. For the private sector, you don't get into real estate like you get into trade finance or something else that's got a 30 or 60-day turnaround. This is a long-term market. The instruments, the debt instruments are long-term, 5, 10, 20 years. And the market cycles are long-term. If you bought a house in Washington, I did in 1990, you might have seen its price go nowhere for 8 years. I did. It was worth exactly what we bought it for a long time. And then things changed in the city, and it jumped. So we got lucky, or I got lucky in that case. Many markets are the same way in both developed and underdeveloped countries. And it's not something that you attract an investor to with a quick money, a quick return argument. It's like you've got to find sponsors that want to have a long-term bullish view on the economy of the country in which you're working, that have deep roots in that country, and that are willing to work through up and down cycles that can last years, that have the patience to wade through cycles like that. And that's not always easy to find. We've been fortunate in a number of countries, but where you don't see us as active, it's often because we haven't yet found those kinds of partners. And that's generally the kind of search that we're looking for.
Excellent. Thank you very much. We have been receiving a lot of questions. Very thankful for that. And I suggest we move to those questions, because I think we can leave time for that. And I would also encourage you here in the audience to just get up and ask a question if you, at some point, you don't have to use necessarily the Paul F system. So there was an interesting question from Victor Vergara, who is on mission right now, asking this question from Kigali in Rwanda. And it's a question for you, Mr. Elizondo. Victor is asking a question about abandoned houses in Mexico. He believes this is a serious problem, and he traces the source of this problem to the perverse government incentives to locate housing for poor people in remote areas where I assume the demand is not there, as a result of which you have abandoned housing and an exacerbated problem rather than solution to a problem. Can you comment on that and share your views on this question?
Yeah, thank you very much, Victor. Actually, I will take some of the comments of the panelists to answer the question. First one is one comment that Britt made, that in order to have sustainable housing in the long term, you will need that the private sector would have a financial incentive. So these houses that were built far away from the center of the cities, well, if you analyze the way the model worked in the 2000s, let's say from 2000 to 2008, most of them were actually, let's say 80% of the financing for those developments came from the Infonavit. Now, I remember having meetings. I was working for the Sociedad Hipotecaria Federal, this wholesale lender, and we represented, let's say, 25% of the new origination. I remember having meetings with Infonavit on this topic about how were they developing finance and which areas were they financing. And in your question, if I'm not wrong, you mentioned how can housing finance help to correct this problem. Well, at that point, it was maybe the other way around. The housing finance that was done was actually urban planning was mostly directed via Infonavit in an indirect way. Infonavit would have the census of all the beneficiaries of formal workers. This census will be divided into the different areas of the country, and they will send each year a signal to developers that houses, there will be a supply of mortgages of X amount for each area of the country. So developers, they would do is to buy land in all those areas, prioritizing those areas where Infonavit would provide mortgages. And then this land, after 2 or 3 years, will become eligible for a mortgage loan by Infonavit if the house was built under certain conditions. And then they will be asking, reading Infonavit year after year, where the Infonavit will be financing. So what I want to say is that this model of urban planning was mostly directed by contradictorily housing finance institution. So the problem was not that how can they help. Actually, if it was not because of Infonavit, those houses wouldn't have been built. So the answer is what you need is a higher area in the government that will coordinate the different entities in order to focus housing finance to the areas or the houses that make much sense to the cities to develop. So what has been happening? Well, in 2013, this model was found to be perverse in the sense that the houses were being abandoned, and the new administration changed the incentives in the table. First, 2 things were done. One thing was there was more coordination in between the institutions, not only housing finance, but also all the government bodies that develop urban policy came together under the umbrella of a new ministry. That is one of the actions. And the second action was to limit the amount of subsidy that was given to houses that are far away from the cities, benefiting vertical housing. Some of the figures right now, actually I just got the statistics that when you got this period of 2007 to 2010, the horizontal housing was 8% of the origination or in the registry. Actually, all the houses that are being built, we have a registry, so we know when they will be finished. 8% was vertical housing. Today it's 27%. So this is actually the way it has been corrected, and things look much more organized. But it's still a reality that most of the developments that were done in that period were abandoned.
Excellent. Shows how complicated and interwoven the various issues are, particularly with urban development and so on. But if you wanted to comment on it, or
Just very quickly on this question of the location of units. One of the things that IFC did was in the wake of particularly the Mexican experience was work with our colleagues in the urban sector to develop standards. So our manufacturing and services now, when they're looking at financing residential developments, look at the location of amenities, jobs, schools, transportation networks, and we make more of an effort now to think about projects in that context of urban development in a more holistic sense, because in essence, it's a better investment when it's done that way.
So. No, I think I personally have heard a number of observations regarding to the challenges and also the difficulties of looking in this holistic fashion, and especially in these so-called externalities where a lot of land use developments increase in values, and then the financing options that this creates that have not been probably exploited or taken advantage of as much as they should have in our operations. A number of questions related to these affordability issues and the various instruments and approaches to making housing more affordable. We know that often many of the overall housing development actually exacerbates the affordability problem by increasing values and properties and prices and so on and so forth. But I think some of you referred, but if you can take on this, there were specific questions about incremental housing, financing, and other instruments and tools, and especially what the World Bank Group is doing to move into that direction. Why don't I go to you, Britt, because you have worked on this quite a lot, and I'm sure you have interesting things to share with the audience.
So broadly speaking, as the report notes, as we look at developing commercially viable mortgage and housing markets, we have not typically found it possible to move the whole development industry and banking industry from the top, where it generally starts in most countries, to the very base of the income distribution. It's too much of a leap for most builders. It's a very different business model for the builder. It's a very different business model for the lender as well. What we have had some success doing in a number of countries, Mexico is one of them, India is a great case in point nowadays, is start sort of with the middle income earners defined in terms of their expenditure capacity per day. Not so much in statistical terms of being the median income, but having a capacity to have a stable enough income to make a mortgage payment over 20 years on a commercially viable physical product. So something that sells that a developer is willing to build or able to build technically and financially, and then move that down in stages. So 30 years ago, when IFC was an equity investor in Housing Development Finance Corporation in India, it was, and it still is today, primarily financing young professionals, young computer programmers in Pune or other technical cities in India who are just buying their first apartment. We've moved quite a bit beyond that as an institution, and we're financing now value-based housing on the supply side, which produces $5,000 and $10,000 units, and a company called Aadhar on the financing side, the consumer finance side, in poor states of eastern India and Orissa that are financing construction of houses that are between $5,000 and $10,000 per unit. So over time, as we have found more partners to work with, and as the different state governments and the national government in India made it feasible to work down market, we've been able to successively work down market. So that's thinking about the formal sector. When you think about informal housing and incremental housing, which I've seen come up on a number of the comments on the web here, we work with micro lenders to finance what most people do in the world, which is build their own house a little bit at a time on a parcel of land that they may or may not have official title to. The more title they have, or the more stability they have in title, the more willingness there'll be to invest in the unit that they build. So in Peru, in informal parts of Lima, you will see people they'll get access to a piece of land that maybe they have some form of gray title to. They start with straw panels, woven straw panels, because in Lima it never really rains, so you can live in a straw house. And they will then, over time, replace those with panels of wood, and then finally bricks, and then finally have something that works. In every place in the world, there's some version of that process that goes on. So with micro lenders, we can work to speed that process up. And some of our successes are in Afghanistan, particularly Haiti, financing a microfinance lender that works to make $500 loans at maybe a longer tenor than the working capital loans it normally makes, and to its better working capital clients that have the extra income to essentially cover a consumption loan. So again, it's not somebody living on $1 a day. It's maybe $5 or $8 a day, but they have an informal business and they can afford a little bit more. So that's something that we'd like to scale up more. And some of there's been constraints to scaling it that have to do with some of the constraints to scaling microfinance in general.
Yeah.
Well, it's a longer-term loan, and it doesn't work for everybody that the microfinance institutions lend for. And some of the observations that a lot of academic economists have made about microfinance lending, it helps people, it helps stabilize income streams and expenditure streams, but it doesn't necessarily pull people out of poverty. What pulls people out of poverty is what they're doing on the productive side. So to the degree that you've got an economy that's delivering more capacity in terms of earnings capacity, then you have more spending capacity, and we can begin to address it. But generally, housing's expensive. Even in a market like Western Europe or North America, people are buying something that's 4 or 5 times their annual income. They need a loan to do it because it's just too much to pay for in cash terms. Yeah. And it's the same thing with incremental housing, just in a somewhat different scale.
Excellent. Okay, thank you. Professor Van Orden, a question to you related to the role of capital market interventions. There was a lot of hope pinned on capital markets to help expand access and make a difference on affordability and housing in general. Where are we now? Are we more pessimistic about it, more realistic about, and especially the role of capital market interventions in poorer economies? There was a question related, are we talking about middle-income countries, this kind of interventions limiting our role in middle-income countries, or we can do something about in lower-income countries as well, using capital market types of interventions?
I guess the first thing, and it maybe gets back to Bert's point, housing finance is not a particularly good way of subsidizing housing or taking care of low-income borrowers, because it's at some basic point you've got to earn a minimal return, and what you can do is make it easier for the market to work. So as I said, in the United States, right now I'm paying about 2.8% on my mortgage. On a comparable credit card, well, I'm not going to reveal my credit rating, but it would be my FICO score, but it would be considerably higher than that. And that's because the market has been set up so that the collateral is good. So I think there's been a lot of discussion in the United States about targeting to low-income borrowers, and was that the cause the crash? It wasn't. I mean, that's pretty clear. But that doesn't mean it was a good policy. It's a pretty inefficient way of helping people. So I like the story really about microlending. We do in the United States the same sort of thing that you were talking about, but we do it by trading up. Mm-hmm. You start out by buying an apartment, or you rent for a while and you move to bigger and bigger houses. A thing that might help in other countries for people who are a little bit affluent is to make it easier to trade houses so you can move up. In terms of capital markets and deposit markets, I think those are just tools. And you need to be careful about saying by opening things up to capital markets or by thinking of capital markets as an intervention, you solve a problem. I think the underlying problem is that people are poor, and you want the capital markets to make it easy for them as they emerge from poverty to buy the things they want.
Thank you. Loic, there were a number of questions related to the role of the World Bank Group. Some degree of skepticism and awareness about the challenge in being relevant and helpful in addressing some of these issues out there. What are some of the challenges we're facing as the World Bank Group working together, IFC, MIGA, the World Bank, in being more effective and impactful in this area? Can you share some of these thoughts?
I prefer to look at the half-full bottle. So look at the opportunities. There are challenges, of course, but I think the more we're working together, the more see the positive dynamics of opportunities. When we release different groups, bottom-up, not just top-down management, but the TTL and the team work together, it works really very nicely for the few experience cases we've been doing in the last 3-4 years. It works much better to reconcile the demand and the supply. What's the point to develop a housing finance systems, even subsidize, you push maturity in the countries where housing price to income would be 20 years of income, right? It means if you have that, you have rigidities on the supply side, which is usually linked to land titling and things like that. If you push the demand by, mortgage finance, you are just going to make a few happy developers, a bit richer, right? So it's important to keep these two dimensions together, to give the public role, state intervention, and the private sector. And the more we work together, the better. I would like to come back, if you may, on affordability and the long term, because both are examples of the way we work together, I think, right? Mm-hmm, mm-hmm. Nowhere now we are just interested to push for housing finance without looking at affordability. It's one of our key objectives. Any projects the World Bank side in the last 3-4 years would have an affordability dimension. Even if it's a long shot, even if we start in an IDA country where the mortgage market is 1% of the GDP or less, right? We'll try to keep in mind how can we push affordability, even it's a long-term trajectory. That's an important thing. And the kind of thing we're doing to answer some of the questions is it's not one miracle panacea solution. It depends the context, yes. Mm-hmm. And incremental housing requires finance. It can be for incremental housing or, as Britt said, for home improvement. People who may not have a title, but their life will change. If we can help them to improve their homes, the value of their home will improve, and a lot of indirect positive effect about that. So yes, even including, in Central Asia, in Africa, in South Asia, we tend to work more with housing microfinance institutions, housing microfinance. I don't know if you know it, but in average, when you speak with microfinance institutions, if you look at what we call productive microfinance, which is a bread and butter of microfinance, according to surveys, about 15 to 20 to 25% of all microfinance are used for housing, even it's not qualified like that, right? Then it's a story of graduation, how to go a bit longer term, how to manage the risks, how to go from collective guarantee to individuals, etc., etc. Another thing we do more compared to the past together as a World Bank Group, work more in rental finance. This is something, you don't have to have one-time solution for the whole lifetime. Mm-hmm. People have their job mobility. They're young people, people who are inclined to have job mobility. It's not always a good idea to lock somebody with 25 years mortgage. So it's important. More and more countries are working redeveloping. And for example, in Latin America, this was taboo. It was not existent. Rental was ignored by the Ministry of Housing. It's coming back big time in Mexico, but also in Argentina. The city of Buenos Aires has done a very great program on that, and we're scaling up now that Mr. Macri has become the president. So this kind of thing, which is important. In terms of long-term, yes, in some countries, we are really trying to push the maturity of the lending. If it's a reasonable interest rate, macro conditions, like when we did in Jordan, we did the project, was quoted, right? At that time, the macro was pretty good. We're in a range of interest rate at 10, 11%. When in this range, which is pretty good for most countries where we operate, and we manage by doing this liquidity facility to go from one bank doing 10 years to 20 banks doing 20, 25 years, that changed completely the affordability condition. Suddenly, from, let's say, 10% of the population eligible, we went to 50, 60%. We still have a low bottom, correct. But at least all the middle income part was tackled. And I think the kind of range, to give you a sort of sense, a flavor of what kind of thing we can do, in Morocco, when we work, I mean, the middle income, the formal employees were pretty much taken care, a bit like Infonavit in Mexico. I mean, we can push, we can help, we can put subsidies for this and so on. But the big bulk of the problem was informal income. This was 52% of the population in Morocco. And I think it's more or less the range of what we speak in Mexico, half of the population. And you know, banks don't know how to handle that. And some of these people want a 20 years mortgage, not just an incremental microfinance. And some of them can repay, but the banks didn't have tools. So at that time, we capitalized a guarantee fund to help a 50-50 pari passu between the private sector and the government. By now, after 12 years, we have 150,000 households who got a credit guaranteed by the guarantee fund. And these were all of them informal income. So the marginal, I'm coming back to my point I made 20 minutes ago. The key thing is what is going to have the most marginal impact, right? Mm-hmm. And in some cases in India, we're working with IEG and the government, on such a guarantee fund. We have two of them. One is more mortgage, the other is for the informal. So it's a story of try to find an entrance point where you have the best impact. And on the local currency, and this was on a question of long term.
There was, yeah.
It's part of the G20, I would say. The G20 has been pushing back institutional investors. I mean, the drive was more for infrastructure finance because of the gap. But we see there are a lot of similarities between long-term infrastructure and long-term housing finance. Both require long-term local currency funding. It's perfectly fine to have a banking system transform the excess of liquidity up to a point. And there's a key thing, right? There's a moment where the banking sector, exposed now to Basel III, which means a whole new world of asset liability, can not do much more. And then you have to bring institutional investors. And there's not one recipe. And typically the World Bank group, and I say group, both IEG and World Bank, we develop a whole range of instruments when it makes sense, when we have domestic investors, when we have insurance pension funds, and we try to develop, the key thing here is to be agnostic. We don't believe in securitization model vis-a-vis versus the cover bond model in Europe. It depends. If it's on balance sheet or balance sheet. As we speak, with the World Bank, we work in 8-9 countries to pass a legislation to introduce cover bonds. We have help of 4 or 5 governments to reform, modernize the MBS market for securitization since the crisis. As you have said, we've been working about 8 to 10 countries for liquidity facilities. So the key thing is for us, when it's possible, it's not always possible, to mobilize institutional investors, including domestic. You don't go to global investors if you have not proven that you can mobilize your local investors to develop long-term solutions through capital markets. But as Britt said, it's not going to be the panacea. And there are a lot of countries, and Bob said that as well. There are countries where it's not the point, So we try to tailor the solutions where it's deemed relevant. The last point is to say the G20 is put it really big, how to mobilize long-term local currency markets.
Thank you very much. I think we have come close to the end of our session. I just would like to give our panelists just 15 seconds each to leave us with their final parting thoughts. They can reiterate something that they have said, but something they believe it's important to leave the audience with. So 15 seconds, just something that they believe it's important for us to take away from this room. Why don't we start with you, Professor?
Housing finance is fun, but it's not a good subsidy tool.
Excellent. Britt?
The private sector is essential, and we're having some success getting them involved, increasing success.
Excellent. Good.
Actually, it has to do with the report, some of the conclusions. You will need non-regulated entities on the time, to serve this housing finance sector. The banks, with the new regulation, are away, and that will necessarily need some kind of partnership with the public sector.
Public sector, excellent. Loic, you have the final word.
But read the report. It's worth it. And these are highlight sections because each of them makes sense, right? And I really want to thank again the IEG for doing that. Yeah. When operation, we need you to come and give us some distance perspective. That's one. Second, I said it's a journey, but don't be shy. It's feasible. We have done it, and we have success stories. So I've met too often TTRs who are shy, say, it's going to be really very complicated. I don't understand a lot of politics. It works, but we depend on you in an operation in the region to take the challenge.
Excellent.
Sorry, just,
Yes.
I'm sorry.
Okay, you
but let
have
me
to
just-
have the final word. You
Well,
couldn't.
I couldn't, there's this great question here.
Okay.
Malena, did you ever rebuild the house? What happened? You left us hanging.
Excellent. Thank you. Thank you.
The house, we had to sell the land to, and sometime we had to go to an apartment. Like
So kind of a good outcome.
Semi-happy ending.
it's more of a happier outcome.
More
Happy ending.
Happy
Okay,
ending.
good.
Okay.
Good. Glad to hear it.
Colleagues, thank you for joining us, and join me in thanking our panelists, Malena and